In January 1986, 4 months after the Plaza Accord, the Bank of Japan implemented monetary easing policies. The measure was carried out by lowering the official discount rate. Policymakers lowered the rate in January, March, and April. The official rate is the interest applied when the central bank lends funds to other financial institutions. When the rate is lowered, money flows more easily to other banks, and the volume of funds in the market increases.
"この1年間に1平方メートルあたり67万円余りだった土地の価格が133万円とほぼ2倍になりました。異常な上がり方です。
The BOJ repeatedly lowered interest rates over a short period. This increased the investment banks made in real estate and boosted the rise in land prices.
Three months after the ball dropped, so did the stock market. The dot-com collapse and 9/11 attacks put to the test Greenspan's view that bubbles could be cleaned up afterwards. And he quickly responded with a series of interest rate cuts to soften the blow.
The Fed says the housing market is solid, but others say there's reason for caution.
Before then, banks made a profit by lending to companies. But after regulations were eased, many businesses were able to procure funds directly from financial markets. That forced banks to cultivate new borrowers. They set their eyes on the real estate industry, which was enjoying a boom thanks to rising land prices.
On the other end, the clock was ticking for either the merger of Travelers and City to be voided and dissolved according to the still active Glass-Steagall, or for Greenspan and his like to succeed in repealing the law before the 2-year window came to a close.
Bankers made increasingly exaggerated assessments of land value, so that the actual ratio of land value to loan often jumped to 300% or more. To the public, this was a strange phenomenon. People soon dubbed it excess money. Only economists, analysts, and those working in the financial markets or for real estate firms knew better. They dismissed such simplistic analysis. Land prices were going up due to far more complicated reasons than just excess money, they claimed. Ordinary people simply did not understand the intricacies of advanced financial technology.
The more banks extended loans, the more land prices surged. Stock prices rose as well. Over a period of 4 years, the market tripled in value. Japan was entering an era of unprecedented economic growth. It was flooded with money, and all that cash transformed the Japanese people. Gold was all the rage. Noodles flecked with gold leaf became a hit. And even sushi rolls got the treatment.
I crapped gold.
When a country creates too much money, some of that money spills out abroad in the form of investments. In the 1980s, Japanese capital flows multiplied from a net inflow of more than $2 billion in 1980 to an outflow of $132 billion in 1986. Assets, including art objects and other valuables all over the world, became targets for Japanese buyers. There were high-profile purchases, such as the Rockefeller Center, Columbia Pictures, and Pebble Beach Golf Course. Japanese money bought a staggering 75% of all United States Treasury bonds auctioned off in 1986. But it is not easy for a country to just print money and then go on a shopping spree around the world. Japan was able to do this because the markets did not devalue its currency. The value of individual currencies is set by currency dealers. If the traditional indicators that the currency dealers watch do not pick up the excess money creation in the country concerned, then creating large amounts of money and trying to exchange it for foreign currency can work. Japan had pulled off the same trick that the United States had used in the 1950s and 1960s, when US banks excessively created dollars. Corporate America used this hot money to buy up European corporations, while the United States had the cover of the dollar gold standard. Japan's cover was a significant trade surplus.
Australia is a hugely popular place for Chinese investors. They're investing heavily into real estate and infrastructure projects. Just take a look around here. It's not hard to find Chinese money flowing into Australia.
This year he expects to conduct over 100 similar tours, with most of his buyers coming from China. All are interested in buying real estate in BC. They'll be looking at a home with an asking price of $14 million. It's won numerous design and environmental awards. The buyers are looking for a weekend place, as they already own property on the west side of Vancouver.
So just under 68 acres, and there's about 1,400 feet of oceanfront, low bank, yeah.
The home is being sold on the private listing service, or PLS.ca. It allows British Columbians the opportunity to discreetly sell their homes to Asian buyers without a for sale sign on the property. These Asian buyers have allowed us to film their trip, but don't wish to speak on camera.
You know, one of them's north of $1 billion, and a couple others are in the several hundreds of millions in this example. But beyond that, you know, their names and who they are and what they do and whatnot, it's best kept private.
Beijing's Angbang Insurance Company is buying the Waldorf for a record-breaking $1.95 billion. That's the highest price ever paid for a U.S. hotel, and also the largest acquisition of a U.S. real estate property by a Chinese buyer.
An early warning indicator of the build-up of systemic risk in the banking system is the ratio of loans for non-GDP based transactions to total loans. This ratio increases significantly in most countries that are subsequently struck by a banking crisis. It was this same process that fueled the mortgage lending and house price booms in the United States and the United Kingdom in the 1980s and the 2000s. The same process also created the Golden 20s. In the 1920s, United States banks lent with stocks as collateral. The principle remains the same. As each bank took the stock price as a given, it created new money. With more money in the stock market, stock prices had to rise. Each bank thought it was safe accepting a certain percentage of the value of the stock as collateral, but the actions of all banks together drove up the overall market.
Former BOJ Executive Director Tsukuda says it was around this time that a sense of caution intensified within the central bank.
The aggressive activities of financial institutions were starting to attract notice. We all realized that, at the very least, the official discount rate should not be lowered any further. That was the widespread understanding at the bank.
But even though they realized that abnormal loans were being extended to the real estate industry, policymakers continued to lower interest rates.
The Fed's lowered from 5.25% to essentially zero over the last 2 years. Unemployment rate's gone from 4.5% to 9%. So it's clear we can't control unemployment rates with any precision whatsoever.
Which means it should never be given a mandate to worry about the economy, to worry about employment. Because if it has to do that, it will manipulate asset prices, which is what it does.
I don't know what the equilibrium rate of interest is exactly, but I'm very confident that it's not zero.
And then the bank was hit by an unexpected incident in the United States. In October 1987, the New York Stock Exchange crashed. The day came to be known as Black Monday.
It was just going down and down and down, never stopped.
Share prices plunged, and the effects rippled from the U.S. to Japan and across the globe. If central banks raised interest rates at such a delicate time, they would run the risk of dampening the economy. That could cause turmoil in financial markets. So the BOJ was forced to abandon the idea of raising interest rates.
Everything underwent a dramatic change on Black Monday. Especially in terms of the official discount rate. Everyone became timid. And raising rates was not even discussed.
For over 2 years, the Bank of Japan maintained low interest rates. It finally raised them in May 1989. In December of that year, the bubble hit its peak, and the Nikkei index topped 38,000 yen.
A central bank can withdraw money from the economy by selling its assets, just as it can inject money into the economy by buying assets. When central banks buy and sell assets, they increase or decrease the amount of money circulating in the economy.
Doesn't surprise me that these continue to increase. The percentage of the ETFs that are owned by the Bank of Japan is now at 75%. 75%. We are talking about extreme levels. Nobody else buys this garbage. It's just the Bank of Japan. And it's not just the ETFs they're buying.
That this structural transformation or reform may produce deflationary forces in the short run, but will generate a much more efficient economy after a while. Independent observers suggested that domestic demand had to be boosted by government spending, and then loan demand would also rise. For a decade, the government followed their advice, boosting government debt to historic levels. Between 1992 and 2002, 10 stimulation packages worth 146 trillion yen were issued.
The president's plan would allow the Treasury to buy up to $700 billion worth of bad loans, like many of those subprime mortgage deals. That means banks would be back in business, able to make loans again.
Transition aides say the goal is to get the bill signed into law as quickly after the inaugural as possible, to get the new president a quick victory while also giving the economy a shot in the arm. The emerging plan includes billions for backlogged transportation projects to beef up construction jobs and improve the nation's infrastructure, as well as modernizing crumbling public schools to create jobs while also investing in education.
If we don't do this, it will cost us even more. This economy is now in the worst shape since the Great Depression. And if we do not respond in a very firm way, it gets worse and worse and feeds on itself.
But Republicans are making noise about slowing the stimulus plan down because they're wary about the price tag, especially on top of a series of government bailouts.
I think most American taxpayers now are sort of scratching their head, wondering when all this bailout stuff is going to end, and probably thinking, you know, when is my bailout coming?
I bet you're the kind of guy that would fuck a person in the ass and not even have the goddamn common courtesy to give him a reach around. I'll be watching you.
So let's look at data for the United States. If we go back to 1950, from 1950 to the present, we'll look at quarterly data and compare changes in government spending to economic growth. Now, if stimulus spending worked, what we should see is as the government increases spending, we should see the economy grow, and in periods when the government cuts back on spending, we should see the economy contract. And that's not what we see. When we actually look at the data, we just see a cloud of nonsense. We can give the benefit of the doubt to the government by doing things like comparing government spending today to economic growth next year, or comparing the weighted average of government spending over the past 4 quarters to the weighted average of economic growth over the next 4 quarters. We can do those things, and what happens is, in the best case scenario, what we see is still no relationship between government spending and economic growth. In the worst case scenario, we actually see a negative relationship. That is, as the government spends more money, the economy actually contracts. A colleague of mine and I conducted a study of federal matching funds in Texas. And the question we were asking is, what happens as federal money comes into the state of Texas? And what we found was that actually for every dollar of federal money that comes into Texas, eventually Texas economy contracts by more than $1.
Good evening, I'm Shannon Bremen for Brett Baer. Senate Minority Leader Chuck Schumer calls it a genuine breakthrough. The White House says it ends crisis-to-crisis budgeting. A new spending deal in the Senate would shower both the Pentagon and domestic programs with almost $300 billion above existing limits. Whether conservatives in the House will go along with it remains to be seen. And then there's Nancy Pelosi.
Let me see if I can put this in a very simple way. There's a certain total amount of resources that the United States has available to it. Call it 100. If government spends 50, only 50 is available for private enterprise to use or private individuals to use for consumption and production and saving, investment.
From the White House on down, get all upset when consumers aren't spending because, you know, consumption is 70% of GDP. It's a big chunk. We have the highest consumption to GDP ratio of any country in the world. So that is what's driven this economy. But that's fine. But who's doing the investing?
Contrary to common conceptions, it's not that the government is giving you money that you can now spend. Rather, the government is taking money from you in the form of taxes, in the form of borrowing, and telling you how you're going to spend that. We all have a limited amount of money we can spend. What matters to us is that we take these limited resources and we use them in the best possible way. And that can take the form of, you know, you've got $20 in your pocket and you want to spend it on this versus that. Or it could take the form of a company or an industry has a fixed amount of resources that it could use to produce this product versus that product. So everywhere in the economy, we're always making these choices as to how to use our resources, how to use our money to get the most out of this. Economic contraction occurs when someone comes in and tells you you must spend your resources in a way that you would not choose to spend of your own volition.
Having recently completed both the world's most extensive system of expressways and the planet's longest high-speed rail network, China is now looking beyond its borders for opportunities to keep building. President Xi Jinping announced at a recent summit that Beijing has sealed mega-project deals with 65 countries throughout Eurasia and Africa to construct ports, power stations, rail lines, roads, and all the tunnels and bridges needed to connect them back to mainland China. At a total cost of over $1 trillion, the One Belt, One Road initiative is unprecedented in size and scope. So is the bold funding mechanism. China will use its large, state-run banks to provide most of the financing. A risky move when you consider how few of the nations in the OBOR could afford something like this on their own. Oh, say the leaders of economically challenged underdeveloped Laos, Yemen, or Ethiopia, or the blood-soaked regime of Bashar al-Assad in war-ravaged Syria. You want to loan us billions of dollars to build some cool stuff in our countries? Of course, why not? China is hard selling the project as a way to boost its westward connections, an update of the Silk Road trade route that played a significant role in developing China and the rest of the region 1,000 years ago. But many analysts see this comparison as little more than a marketing pitch.
Now, what about what difference does it make which way it is financed? It does make a difference. What we call a deficit is simply a form of taxation. It's hidden taxation. It's taxation in one of several forms. It may be, if it's really financed by printing money, then it's taxation in the form of inflation. If it's not financed by printing money, it's a invisible tax on all property because you own a piece of property. But you have to figure from the future income of that property, then more of it will have to be taken from taxes in order to finance this debt that is here. So and those are bad taxes. They're not wholly bad taxes, but they're not good taxes. And therefore, I would prefer not to finance by deficits.
The fallacy in stimulus spending is that we're only looking at half the picture. We see the money that's spent, and we completely ignore the taxation that raises that money in the first place. So the question is, how do we stimulate the economy? And the answer to that is sitting right in front of us. It's the private sector. And by private sector, I don't mean business. What I mean is free people allowed to make decisions that are in their own self-interest. So when you go to the store and you choose brand A over brand B, you're rewarding a company for a job well done. And when a company looks to spend its money to invest, it looks around to see how it can serve people in the best possible way because it knows when it serves people well, that creates profit for the company. That dynamic interaction a free interaction between consumers and producers is what generates jobs, it's what generates wealth. The best thing the government can do to encourage that interaction is to get out of the way.
I don't know that they're going to get larger deficits. Maybe the first year or two, okay, or even the first three. I'm here to say, and a lot of Republicans believe this, not all, but many, I'm here to say that the business tax cut side is going to pay for itself. Give it a couple, 3, 4, 5 years, okay? That's what I believe. Now, you want...
He joins us now to share his views on where the Japanese economy is heading. Mr. Verna, good evening to you. Thank you for joining us.
The government was spending with the right hand, putting money into the economy, but the fundraising was done through the bond market, and therefore it took the same money out of the economy with the left hand. There was no increase in total purchasing power, and that's why the government spending couldn't have an impact.
The Federal Reserve wants to shrink its $4.5 trillion balance sheet, and that may force interest rates to rise faster than you think. The Fed's balance sheet grew from about $1 trillion before the 2008 financial crisis to about $4.5 trillion currently. The balance sheet grew as the Fed bought a massive amount of Treasury and mortgage bonds to keep rates low and...
I think you all know that I've always felt the 9 most terrifying words in the English language are, I'm from the government and I'm here to help.
At times, the Bank of Japan even actively reduced the amount of money circulating in the economy, which worsened the recession.
Many companies were forced into hard times. Struggling firms implemented streamlining measures by restructuring their employee relations. Irregular employment increased, and social inequality became a serious issue. Prices continued to fall, and Japan experienced a long period of deflation. The prolonged slump has been referred to as the lost 20 years.
And you must be the Monopoly guy. Hey, thanks for the free parking.
And one of the arguments against equities lately has been that you're going to see the peak in the cycle because the yield curve has been flattening. It's currently about 60 basis points on the 2-10 U.S. Treasury spread. So, and historically, when you look at the last 3 cycles, from the initial move to that 60 basis points, which happened last week, your median gain is 63% in over 1,080 days for the market. So we are so far from quote-unquote the peak. It depends on, I'm 100% buying the dip. You never, ever, 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 ever want to get negative on and overly defensive from an intermediate to long-term basis before you have an inversion of the yield curve. Every correction
Do not pass go. Do not collect $200.
The Austrian theory explains in a way that other schools of economic thought have been unable to explain why it is the government, the central bank, the overextension of credit, the creation of too much money, that in effect, inevitably almost, sets the stage for an economic downturn. And of course, politicians, being very short-sighted and only thinking to the next 6 months or the next election, will like the euphoric short-term sense that you get from excess money creation, but they never could quite understand why that creates bad economic conditions down the road as individuals and businesses and the economy are unable to sustain the economic activity that has been generated by that easy money policy. And the Austrian theory explains that it is the inflation that governments are so prone to engage in that sets the stage for economic bad times. And if you go through history and look at when we've had periods of economic contraction, they are almost always associated with some sort of mismanagement of the monetary system by the government.
In this present crisis, government is not the solution to our problem. Government is the problem. Work with us, not over us. To stand by our side, not ride on our back. Government can and must provide opportunity, not smother it. Foster productivity, not stifle it. If we look to the answer as to why for so many years we achieved so much, prospered as no other people on earth, it was because here in this land we unleashed the energy and individual genius of man to a greater extent than has ever been done before. Freedom and the dignity of the individual have been more available and assured here than in any other place on earth. The price for this freedom at times has been high, but we have never been unwilling to pay that price. It is no coincidence that our present troubles parallel and are proportionate to the intervention and intrusion in our lives that result from unnecessary and excessive growth of government. It is time for us to realize that we're too great a nation to limit ourselves to small dreams. We're not, as some would have us believe, doomed to an inevitable decline. I do not believe in a fate that will fall on us no matter what we do. I do believe in a fate that will fall on us if we do nothing. So with all the creative energy at our command, let us begin an era of national renewal. Let us renew our determination, our courage, and our strength. And let us renew our faith and our hope.